If demand goes up, it just attracts a lot more competition. And any profit advantage from the higher demand gets competed away. If costs go down, you make temporary profits, but then everybody enters trying to take advantage of that. Prices go down, product offerings fragment the market more thoroughly. And again, consumers benefit from that. So what you absolutely have to have if you're going to earn superior returns is barriers to entry. And if you don't earn superior returns, growth has no value. So there are a whole bunch of industries, natural resources, real estate, competitive businesses with no barriers to entry, but you can't worry about and pay for growth, as most people try and do under those circumstances. So what you've got to do is segment the world into businesses that benefit from barriers to entry and businesses that don't. And there is, it turns out, a simple numerical number that will tell you how high the barriers are, or in the language you just articulated, how wide the moat is. And the first element to that is economies of scale expressed as the minimum sustainable market share you need to be viable. So if you look at the global automobile market, it's so big, people are viable at 2% share. And you're not going to keep anybody out in that world. If you look at cell phones, you can see around the world, people who have 10% share, 8% share, 12% share don't make money. People who have 15 to 20% share break even. You got to be above 20% share to make money. So the minimum sort of profitable share is sort of 15 to 20% there, and you want to be above that. If you look at caffeinated soft drinks, where you've got these huge local infrastructures to deliver what are very heavy products, typically you have to have at least 25% of those local markets to be viable. So that's where you start. And that's where the economies of scale cut. And just by looking around at the industry structure, you can get an idea of what that number is. Well, the second thing is, how long is it going to take your rivals to acquire that level of share? And that has to do with market share stability in a contested environment. So if I have lower costs, that's clearly going to give me share stability. It's not just about customer captivity. So it's looking at market share stability in a contested environment. In the automobile industry, that number is 2% a year share changes hands on average. So you've got a 2% viability threshold. You can acquire share at 1% a year. That's a 2-year moat. That's nothing. There are no barriers there. If you look at cell phones, you've got to sort of get, say, to 15%. Turns out about 0.5% changes hands every year in a contested environment. That's a 30-year moat. That's starting to be a much more protected market. You look at caffeinated soft drinks, again, you got to get to 25% locally, because these are local monopolies in that case. Coca-Cola makes 108% of its operating profits in just 10 markets. And basically 0.2% market share changes hands every year in a contested competitive environment. Well, to get to 25% at 0.2% a year, that's a 125-year moat. That's a moat. And that's not going to go away for Coca-Cola, even though you may have growth within the moat and or shrinkage within the moat. That's the measure of the moat. And I think that's the number everybody wants to think about and concentrate on when they evaluate the businesses they're getting into. Now, then there are two other dimensions to the moat. The first is the one I just described, which is the market growing or shrinking behind that moat? And obviously, it's much better if it grows than it shrinks. But the second thing is technology changing those parameters? Is this a franchise? Is this a moat that's going away or not? And that's a separate thought experiment. It has to do with how your competitive advantages are changing, how the economies of scale are changing in response to technological and other developments. But I think you've identified in that question the absolutely crucial elements when you start evaluating franchise businesses and you start paying for growth.